What if I told you that two people can start with the exact same amount of money, make completely different investment decisions, and after 20 years, end up in almost the same place, but with entirely different lives? Sounds strange, right? Because most people don't think about investing like that. They think in terms of which one makes more money. Real estate or stocks, property or index funds, active or passive. But the truth is, the real difference isn't just in the final number. It's in everything you go through to get there. Before we go deeper, quick question for you. If you had $50,000 right now, would you buy property or invest in the stock market? Comment below with your choice, because by the end of this, you might completely change your mind. Let's make this real. Jake buys a rental property. Marcus invests in index funds. Same starting point, same money, same income, same city. The only difference is the decision they make with that $50,000. Jake uses it as a 20% down payment on a $250,000 rental house, a simple 3-bedroom property in a decent neighborhood. He takes on a 30-year mortgage at 7% interest, locking himself into a monthly payment of about $1,330. Then he finds a tenant willing to pay $1,800 a month. On paper, that's $470 in monthly profit. And just like that, Jake feels like he cracked the code. Marcus, on the other hand, does something far less exciting. He takes the same $50,000 and puts it into a total stock market index fund. No leverage, no tenants, no keys, just a simple investment. Then he sets up an automatic contribution of $300 every month and moves on with his life. No one is impressed. There's no house to show, no story to tell at dinner, no visible proof that he's doing something smart. Just a number on a screen that rises, falls, and rises again. And this is exactly where the illusion begins. Because in the early years, Jake looks like the clear winner. Every month, rent hits his account. He drives past his property and thinks, I own that. He talks about appreciation, tax benefits, and passive income. What about the risks? How do I get started? That's where we come in. They're curious, maybe even a little impressed. Meanwhile, Marcus logs into his account once every few months, sees small changes, and logs out again. Year 1, his $50,000 grows near $55,000. Year 2, maybe $61,000. It still feels slow, almost boring, like nothing is really happening. But here's the problem. Feelings and math are not the same thing. By year 3, the numbers start telling a different story. Jake has collected roughly $64,000 in rent. The reality, property taxes cost him around $3,000 a year. Insurance adds another $1,500 annually. Then come the surprises, a $1,200 water heater replacement, a $2,800 roof repair, and a vacant month that costs him $1,800 in lost rent plus $600 just to clean and relist the property. Suddenly, that easy profit starts looking far less easy anymore. After all real expenses, Jake's actual cash flow over 3 years drops to somewhere between $2,000 and $4,000, not per year, total. And that doesn't include a single hour of his time. Because here's what no one talks about. Jake didn't just buy an investment. He bought responsibility. Late-night phone calls, weekend showings, coordinating repairs during lunch breaks, screening tenants, dealing with problems that don't wait for convenient timing. He saved money by managing it himself, but that just means he took on a part-time job. He doesn't get paid for. Marcus? He did nothing. And somehow, that's exactly why things are starting to work in his favor. Over the same 3-year period, Marcus invested his initial $50,000 plus $10,800 in monthly contributions. With an average return of around 10%, his portfolio is now sitting near $76,000. No stress, no emergencies, it's the reason real estate looks so powerful in the beginning. Leverage. His $50,000 didn't just buy a $50,000 asset. It gave him control over a $250,000 property. And as that property appreciates, even modestly at 3 to 4% in value to somewhere between $270,000 and $280,000. That means his equity has increased to roughly $55,000 to $65,000. That's real wealth. And it's the one thing that keeps Jake in the game. Because from the outside, it still looks like he's winning. But underneath the surface, something else is happening. Every dollar Jake earns is being chipped away by costs most people ignore in the beginning. Vacancy, maintenance, repairs, future replacements, these aren't rare events. They're guaranteed expenses, just waiting for the right moment to show up. A rental property isn't just an asset, it's a system. And if you don't treat it like a business, if you're not budgeting for the long term, you're not investing, you're gambling. Meanwhile, Marcus is entering a completely different phase. Nothing dramatic happens overnight. There's no sudden breakthrough, no viral success moment, just steady, quiet growth. But under the surface, something powerful. At first, it feels slow, almost invisible. But year after year, the growth begins accelerating. Not because Marcus is doing more, but because his money is finally starting to work for him. And this is where the story begins to shift. Because while Jake is actively managing his investment, Marcus is slowly being pulled forward by a force he doesn't have to control. And over time, that difference starts to matter more than anything else. By year 5, the difference between Jake and Marcus is no longer about excitement. It's about reality. Jake is now fully inside the landlord experience. He's on his third tenant. He's dealt with unexpected repairs, including a plumbing issue that cost over $1,000 and eventually had to replace the roof for $8,500. Yes, rent has increased slightly to around $1,950, but so have property taxes and insurance. On paper, things still look fine. But when you break it down, his real return, the actual cash he keeps after everything, is hovering somewhere between 3 to 5%. Not terrible, but definitely not what he imagined either. Because in the beginning, Jake wasn't thinking about maintenance cycles, long-term capital expenses, or the reality of tenant turnover. He was thinking about that clean, simple $470 number, the one that looked perfect on paper but never existed in real life. Marcus, on the other hand, is still doing exactly what he's been doing since day one. Nothing. And that's precisely why things are starting to accelerate. By year 7, his portfolio has grown to somewhere between $135,000 and $150,000. Not because he timed the market, but because he stayed consistent. His monthly contributions kept going in, and his returns began generating returns of their own. This is the phase where compounding stops feeling boring and starts feeling powerful, because now Marcus isn't the only one contributing to his portfolio. His money is contributing too. And from this point forward, that changes everything. By year 10, something surprising happens. Jake's property has appreciated significantly. It's now worth somewhere between $335,000 and $350,000. His remaining $166,000, giving him equity in the range of $170,000 to $184,000. That's a strong position. After a decade of ownership, repairs, stress, and consistent payments, Jake has built real, tangible wealth. Marcus? He's sitting at really $165,000 in his portfolio. Almost the same. After 10 years, they're in the same ballpark. But look closer. Jake got there by actively working for it, handling problems, managing tenants, and taking on debt. Marcus got there by stepping back, staying consistent, and letting time do the work. Same destination, completely different journey. And this is where the story truly separates. Because the next 10 years don't behave the same way as the first 10. By year 20, Jake's property is worth somewhere between $450,000 and $500,000. His mortgage is either fully paid off or very close to it. His equity is massive, possibly $400,000 or more depending on appreciation. He's also collected rent for 2 decades. But when you subtract 20 years of maintenance, repairs, vacancies, taxes, insurance, and at least one major renovation, his total net cash flow might land somewhere between $40,000 and $80,000. That's not nothing. But it's not effortless either, because every dollar came with responsibility. Now look at Marcus. With the same consistent $300 monthly contribution and an average return of around 10%, his portfolio has grown to approximately $420,000 to $460,000. Let that sink in. Out of that total, only about $22,000, the remaining $300,000 plus, that came from compounding. No tenants, no debt, no emergencies, no midnight phone calls. Just time and discipline. Now here's the part most people miss, the part that completely changes the math. If Marcus had increased his monthly investment by just $200, bringing it to $500 per month, his portfolio wouldn't just grow a little more, it would jump to somewhere between $550,000 and $600,000 over the same 20-year period. That's the multiplier effect of compounding. In the stock market, increasing your input doesn't just add more money, it accelerates the entire system. In real estate, increasing your investment usually means something very different. Another property, another loan, another tenant, another layer of responsibility. Now, to be clear, this isn't about saying because both Jake and Marcus built wealth. That's the truth most people ignore. Real estate isn't bad. Stocks aren't perfect. They're just different games with different rules. Real estate gives you leverage, tax advantages, and control, but it demands time, effort in one place. Stocks give you liquidity, diversification, and simplicity, but they test your patience and your ability to stay calm when everything feels like it's falling apart. And if you think volatility doesn't matter, imagine watching your portfolio drop 30% in a matter of weeks and doing nothing. That's not easy. Most people fail right there. They panic, they sell, they lock in losses. Not because the strategy was wrong, but because they weren't prepared for what it feels like. And that brings us to the real lesson. Jake and Marcus didn't lose. They both won. But the real mistake would have been choosing either path based on a headline, a YouTube clip, or something someone casually said, without understanding the full picture. Because the real cost of any investment isn't just measured in dollars. It's measured in time, in stress, in attention, in risk. So the next time someone tells you real estate always wins, or the stock market always wins, ask them one simple question. Did you include everything? Because the answer that includes everything is the only answer that actually matters. And if you want more breakdowns like this, real scenarios, real numbers, and the kind of financial clarity most people never get, make sure you subscribe. Because this is just the beginning.